This is capital budgeting. Capital budgeting means systematic investment on, what is that? Fixed asset. This photograph, why it came? All right. Here you see, long ago in Dubai, they planned to construct a palm islands. So this is what? By taking in the ship sand, by filling this ocean, they constructed the biggest building ever. So they filled the sand like this, ocean with this ship. This is the ship you're seeing here. Okay. With the ship, they took what? Sand. And at the same time, while going on filling over the period, they created artificial land like this. And thereafter, even to protect this edge, right, they filled with the rocks. And finally, they created this much of biggest building. And this is that building is Palm Island. These many apartments they constructed. And final shot is this. You try to understand, these students, such a biggest construction, such a biggest estimation comes under the category of, what is it? Investment decision or capital budgeting. Are you getting? So what is the capital budgeting? Capital budgeting is the systematic investment on, to make investment on fixed asset. What is capital budgeting? Capital budgeting is the process of evaluating and selecting of what? Long-term investment that are in line with goal of investors' wealth. Any corporate company, when they used to make investment on huge fixed asset, certainly they think that, right, because of making investment, so what would be the maximum benefit we are going to get it? Is it worthwhile to make investment or not? So before making investment, each and every company makes an evaluation. That is called, what is that? Capital budgeting. So capital budgeting is the process of evaluating, selection and long-term investment planning. It enables the financial manager how to invest in fixed asset, how much to invest in fixed asset, whether it is worthwhile to make investment in fixed asset or not. Example for capital budgeting: purchase of land and machinery, construction of factory and building, and the commencement of new business venture. So this is the capital budgeting. So capital budgeting is to make investment, evaluation of what? Either to make investment on fixed asset or not. Sir, without fixed asset, if I make investment, what will happen, sir? See, without proper plan, if you make investment, sometimes, if, here it is, this is the, what you are looking, is it visible? This is called ghost island. You try to understand how many buildings they constructed. They made it a capital budgeting, right? This much of building they constructed, duplex houses you seems to be, but not yet sold. Now try to understand, not yet sold. That means before making investment, you have to understand each and every factor. So how much revenue, how to construct, everything. But previously I showed just now, what is that? Palm Island. The person who constructed an apartments in ocean, middle of the ocean, he sold it. But here it could not. So what is this? You have to make evaluation. Might be the price, what they are charged, may be high. Hello? Might be they fixed reasonable quality, quantity, each, whatever it may be. But try to understand, these many houses you constructed to sell, one fine day you could not able to sell, means, is it essential to make investment? So that is the point. Before going to make investment, what happened? You have to make evaluation whether it is worthwhile or not. That is capital budgeting. That is the most important point you should consider. Yes, you make it note this one. 2 marks question you will get it from this. Maximum I will give you 5 minutes. Make it note. So capital budgeting. Here, the next one is capital budgeting is a systematic investment of investment. What is the purpose? Why we should learn capital budgeting? This is an important. Take it down. Purpose or significance of capital budgeting. You can also go with the word called what? Significance. Significance means importance or purpose of capital budgeting. Why you should learn capital budgeting? Because when you open your office, a client may come to your office, right? The client who has a proposal to make investment on fixed asset is consist of substantial expenditure. Substantial expenditure means more, huge, bulk. Such an expenditure is called, what is it? Substantial expenditure. Since the client who has a proposal to make investment on fixed asset is consist of what expenditure? Substantial expenditure. Substantial means more. Why you have to make a plan? Why you have to possess this skill? Because it includes, what is it? Substantial expenditure. When you want to buy a pen, will you make plan? Pen plan astava. When you want to buy an apartment by spending 1 crore or 2 crores, then you will make it. Why? Because it includes substantial. So that is the reason. The first one is substantial expenditure. And number 2, long time period. What is that?
Recording in progress.
Is it short run or long run? Investment on fixed asset is a long run. If you make investment in productive way, it is okay. But if something without making any plan, if you make investment, so try to understand. Just now I showed a photograph, right? So how many apartments they constructed? Before that, they have to make a plan, right? Do you agree? When you are making this much of investment, at least you should be able to think that whether it is worthwhile or not. 1 or 2 buildings, you try to understand, man. These many buildings they constructed, but not able to sold, not able to sell. So entire gone, right? So that is the point. You have to evaluate whether it is really worthwhile. Can I be able to sell or not? So that is the most important point. So capital budgeting is not a short run period. It is what? Long run period. It includes number 1, substantial expenditure, long time period. Another one is investment on fixed asset is irreversible one. What is that? Irreversible one means when you make investment, you cannot get it money back. That's why before making investment, 1000 times think, 1000 times make evaluation. But once investment is executed, that's enough. So that's why before making investment on fixed asset, being a financial manager, you evaluate whether it is worthwhile or not. Okay, because it is a long run relationship. You know that with respect to marriages in India, what we say, okay, పెళ్లి సంబంధం చూసుకోవాలి, అటు 7 తరాలు చూడాలి, ఇటు 7 తరాలు. వై 7 14 తరాస్? వై మ్యాన్? మీ తాత తరమే నీకు గుర్తురాదురా, నీకు ఎందుకు 14 తరాలు అంటే? సార్, ఇట్ ఈస్ షార్ట్ రన్ లాంగ్ రన్? లాంగ్ రన్. వన్స్ ఇట్ ఈస్ a long run means you have to check 7 but no need. If you can't say 7 then you will start to edupu. That is not a short run edupu. Which run? The long run edupu will be commenced. That is the reason you have to make evaluation, because it is a short run or long run? Long run. Okay, I think there is a cement ad recently. They used to construct, their mother only we used to construct a house. I think either cement man, Nagarjuna not, Ultratech something. Her mother have a dream. Her mother has a dream to construct house, but she may lose. But whatever the money she saves in kitchen, right? That money he used to put on while constructing the base. That is a cement man. Recently, very heart touchable ad, cement ad. Because he will ask, this you are using this cement means, then he will say it is short period or long period? Yeah, for long period means you must use only this cement. Ambuja cement, I think so. Ambuja cement. This is a long period. And irreversibility. What is irreversibility? Since the investment what you will make it is not at all reversible. So that is the reason before making investment you have to think And another one is complex decision. What is that? Complex. Complex means very, very difficult. In order to make investment on fixed asset, is capital budgeting decision is really, really, really complex. Complex means difficult one. Difficult one. So that is the most important point. Why you have to learn? Are you getting my point? You are a chartered accountant. You start a man boy. That one. You are a chartered accountant. You opened office. You are sitting in front of your office. Somebody came, right? You don't have a knowledge of what? Capital budgeting. This is the capital budgeting. This knowledge is not there. If he came to make investment of 400 crores without knowledge of capital budgeting, if you guide him, what he will do? Can you guess? Avuna? If you don't have capital budgeting, sir, 100 కోట్లు పెట్టి బిజినెస్ చేద్దాం అనుకుంటే ఏం చేసే నో ప్రాబ్లం. టేక్ 1 రూపీ. ఎస్ ఆర్ నో? మేక్ ఏ టాస్. అచ్చు పెడితే చేయి, బొమ్మ పెడితే వదిలే అన్నాం అనుకో, ఫ్యాన్ ఆపేసి. అదే నీకు క్యాపిటల్ బడ్జెటింగ్ నాలెడ్జ్ ఉంటే, ఇఫ్ యూ హ్యావ్ క్యాపిటల్ బడ్జెటింగ్ నాలెడ్జ్, యూ విల్ టేక్ ఈచ్ అండ్ ఎవ్రీథింగ్, యూ విల్ evaluate and you will say that, sir, don't worry sir, don't take this one sir, because you know if you make investment, if you can't undertake, right, there is a photograph I showed, right? Such a thing may happen sir. That is a before commencement of any project, you have to evaluate. That evaluation, these are the some important point ma, okay na? Sit down. So being a financial manager, you must have capital budgeting knowledge to guide your client whether it is worthwhile to make investment or not. Not only your client, whenever you are going to make investment also, you can also have this identity. Completed? Purpose of capital budgeting. What are? Number 1, substantial expenditure means what? It includes huge expenditure. That's why you learn capital budgeting. Number 2, it is not a short run, it is a long run. That's why you must learn capital budgeting. Number 3, once you make investment, tooch, nothing janta nahi. That's why before making investment, think 1,000 times, make investment. And next one, it is really, really complex, difficult. Why? Because you have to consider investment, you have to consider cash inflow, you have to consider variable cost, or fixed cost, or tax, or time value of money, government rules and regulations, yes or no, subsidy, working capital, what not. Everything you have to consider and you have to make a guess. It's not a practical. What is this? Just guess. You have to guess in such a way that before commencement of the business itself, you have to visualize what is the profit to be generated. What happens? You know that in old movie, there is a round chakram, flashback. When people want to go to the flashback, right, there is a some round. But here also we have, but we don't go to the past. We will go to future. We will guess what will happen. That is the second one. Next, in order to make capital budgeting, these are the methods, techniques you have. What are they? Methods of capital budgeting. Capital budgeting, see, keep it in mind. Capital budgeting is a certain methods. Each method has some calculation. While calculating, you will get the results. Basing on results, you will take a decision. In the process of calculation, if data is not given, you will take certain assumption. And sometimes you have to follow condition. This is the capital budgeting. You are learning capital budgeting means what you are learning? Tell me. Sir, I am learning capital budgeting means what you are learning. That is most important point. You are learning capital budgeting means see. See, capital budgeting, you are learning means capital budgeting consists of what? Various methods. Capital budgeting has various methods. Each method has its own calculations. And after calculation, you will find the answer, right? Basing on that answer, you will take what? Decision. In the process of calculation, if data is not available properly, then you will take what? Certain assumption. You know, in the process of calculation, you have to follow certain assumptions. Sometimes you have to follow certain conditions. So finally, to evaluate a project, you have to learn capital budgeting means you have to consider all these things. Number one, क्या है? Methods. Each method has its own calculation, and after the basing on the calculation, you have to take decision. This is the step-by-step procedure. But what at the time of calculation, when you don't find proper, what is that? Data support, then you have to take, what is that, Maji? Assumption. You have to follow, what is that? Calculation. So this is the capital budgeting. I am studying capital budgeting means you are not just studying capital budgeting. You are studying all these things in order to take a decision. Make it note, Maji. Within seconds you have to note it, because my notes is supports you a lot. I will assure you 100%, right? I will give you my class is recording, Balasubramaniam. Don't be too emotional. Notes writing, ma? You boy? My notebook. Neither seems to be old. Ray Pellant notebook konalante. Are first no notebook show me notebook, man. Yes. Tera? Good. Amara? Bhaiya aapka? You man? Right. Here? Right. Here. Capital budgeting. If you complete CA, how much money you may earn, man? Of 10,000? Crores of rupees, right? When crores of rupees you are getting means you have to put what? Investment. Can you play for Tirumala Tirupati Devasthanam to give a gundu for the sake of buying a pen, right? When people make, what is it? I will come by walk, right? I will do Annadana means they have biggest dream. Basing on dream, your investment. Change. Immediately change notebook. Go to the shop, ask that, give me a notebook through which I can pass CA. CA pass a notebook అడుగు అసలు కాబట్టి అదేలా సార్ తెలుసుకొని నోట్బుక్ తీసుకురా అని చెప్పండి. CA పాస్ అయ్యే నోట్బుక్ అడుగు అంతే. నోట్బుక్ నోట్బుక్ ఎవడన్నా ఇచ్చేస్తాడు, అవునా? ఏం అడగాలి నోట్బుక్? CA పాస్ అయ్యే నోట్బుక్ ఇవ్వరా అని అడుగు ఫస్ట్ ఆఫ్ ఆల్. నీదన్నా అది చూడరా ఎలా ఉందో, నా సైజులో ఉంది అది. అట్లుండాలి నోట్బుక్. ఎస్ యూ ఓకే. హియర్ మాజీ రైట్. Go to shop, ask a question. What is that? Okay. CA pass hai notebook. Online bacche, this dialogue applicable for them also. Right, ma. Make it note. Capital budgeting is a combination of various methods, calculations, decisions, and you have to follow assumptions and conditions. Okay? Right. What are the various methods of capital budgeting? So methods of capital budgeting being classified into how many methods? Two methods actually. Method number one, traditional methods. Number two, modern method. These methods must be in your fingertips. That is the reason it is better to write once with your own hand. So capital budgeting methods being classified into how many types, Maji? Two types. One is traditional methods. Traditional methods means these are the methods which ignores what? Time value of money. This method is also called non-discounting technique, non-discounting methods. This method consists of two: payback period, accounting rate of return. And modern methods you have discounted. Modern methods means this method considers time value of money. So under this method you will find a net present value, internal rate of return, profitability index. Another name for profitability index is benefit cost ratio and discounted payback period. Which method consider time value of money? Modern method consider time value of money. Traditional method considers, don't consider which one? Which method we ignore actually? CA Institute also ignores which method? Traditional method, because it ignores time value of money. Okay? Okay, shall we take the first method? Here, to evaluate any of the project, right? You evaluate any of the project, being a financial manager, you have to consider or given these facts. Number one, whenever you want to estimate cash outflow, you see, in FM, you never find profit and loss. You will evaluate how much cash is coming, how much cash is going. If inflow is better than outflow, project is worthwhile. When inflow equal to outflow, then okay. When outflow is more than inflow, then the project is not at all worthwhile. So that is the reason in evaluation of a project, you have to collect the following data. First of all, outflow. How much the outflow? Outflow means nothing but investment. In order to buy an asset, what is the outflow? Thereafter, you have to calculate inflows. So thereafter, you have to calculate life. Thereafter, you have to calculate tax also, because you must consider, not calculate. You have to consider cash outflow, you have to consider cash inflow, you have to consider life, and you have to consider tax, and you have to consider PV factors. What is that? PV factors means what is that? Time value of money you have to consider. So here in this cash inflow, there are two types of inflows. One is operating cash inflow, another one is what is that? Terminal cash inflow. So that is the important point to be kept. Okay? While evaluating a project, these are the factors to be considered. What are they? Cash outflow, cash inflow, life, tax, and time value of money means you have to consider present value factor and present value annuity factor. Make it. Yes, ma? Right. So thereafter, you have to calculate cash inflows, cash outflows, life, tax, time value of money. Okay? Here you should understand how the cash flows of the project will happen. See, when a project you are commencing, it's a zero. Why zero means beginning of the day. Hello? Or beginning of the year, today. That is a Y1. Y1 means, Y0 means when? Beginning. You are going to make investment now. This is the cash outflow you can make. Year ending, year 2, year 3, year 4. These are the every year ending, you will get the cash inflow. That cash inflow called operating cash inflow. Operating cash inflow means this is the cash inflow company able to get from the sales revenue. When company sells a product, from that product whatever the cost it incurs, if you, after deducting it, whatever the inflow it is getting, that is called what cash inflow? Operating cash inflow. Every year business means you have to sell, right? But sometimes your cost is more than your revenue, then operating cash inflow negative will come. Whereas your revenue is more than your cost incurred, you will get it what? Operating cash inflow. Every year company has to make a sale. Generally company do sales during the year, hello, or every day. But we take an assumption, already I told you condition. One of the condition is nothing but we assume that during the sales, during this year sales, whatever the sales made it, we will assume that entire sales made at a end. Okay, this is an assumption actually. Year 1, year 2. Year 2 also you will get operating cash inflow. Year 3 you will get operating cash inflow. Year 4 also you will get operating cash inflow. But the asset what you purchased in the beginning, right, you may sell at the end of the period. Hello? At the end you will sell, you may get it another value. That is called, what is that? Terminal cash inflow. What is that? Terminal cash inflow. The asset what you purchased, you are going to scrap it at the end of the period. See, scrap value, salvage value, both are remain same only. But scrap value means you purchased asset at the end of the period, asset not able to use. Nobody is going to use. In such a case, you have to sell the asset as a scrap. When asset is in good condition at the end of the period, but it is not need to you. Hello. In such a case, that asset value is called salvage value. Salvage value means somebody can use that asset, but that asset is not matching our expectations, but it may match some other people expectation. In such a case, that value is called salvage value, but asset is completely dead, you are not at all going to use, then it is called what? Scrap value. Whatever it may be, treatment is remain same only, but title may changes. So at the end of the period, either scrap or salvage value, for whatever the price you will sell at the end of the period, you will get what cash inflow? Terminal cash inflow. If you submit all this cash inflow, you will get a total cash inflow. And now you have to compare with what? Cash outflow. Now tell me feasibility, whether it is worthwhile or not. How do you say? Sum it up operating cash inflow plus add a terminal cash inflow, develop a total cash inflow, compare with cash outflow. If cash inflow dominates cash outflow, project is worthwhile. Cash inflow equal to cash outflow, okay, chalta hai. Cash outflow is more than cash inflow, no need to consider. This is the basic idea. This is the chapter. Finish the chapter. But only thing is how to evaluate this concept professionally, right? For that purpose, first you have to calculate what is it? Outflow. What is the cash outflow? You have to learn each and every line here. Cash outflow means what will get it? This is the data new study material they have given. Number one, whenever client comes, you have to calculate cash outflow. For cash outflow means you have to ask the following question. What is asset you purchased? 4 lakhs. Is there any installation charges? Because asset you purchase directly you cannot use, right? Sometimes you have to incur installation charges. So what you have to do? You have to add back it. Cost plus installation charges. Sometimes, you know, in order to run a business, you have to incur what? Working capital. What is that? Working capital. Working capital means, that is, you try to understand, petrol bunk is there, right? Petrol bunk, you want to start a petrol bunk. ये क्या रे? You see, this is the petrol bunk, right? In this petrol bunk, you want to do such a business. You want to make an investment. Here, two things are there. Number one, petrol bunk, you want to construct such a beautiful one. You see how beautiful this petrol bunk is. ये beautiful नहीं है. Where is this petrol bunk? The petrol bunk you want to construct, right? Now tell me, petrol bunk, what is the fixed asset in this? If you want to start the business, right? Here try to tell me, this is what asset? Fixed asset. This is petrol is, where is it? In this underground. Petrol tank. This is what asset? Current assets. Current assets means the amount what you invest this petrol is called, what is it? Working capital. Now in order to start this business, you have to incur two things. What are they? Number one, fixed asset you have to incur. Number two, what is that? Working capital. Hello. So now I told you what is the cost means here. What you have to consider? You have to take, what is it? Cost of machine plus installation charges plus working capital. And for example, you started petrol bunk at a rural area, government may provide you, what is it? Subsidy. When government gives a subsidy, automatically your investment, what happen? Decreases, right? So that is the reason you have to deduct a subsidy from the government. You will find net sale proceeds from old asset. Net sale proceeds from old asset means, if at all you have old asset, right? In such a case, you may sell that asset. With that amount, you are going to buy new asset. In such a situation, it is also reduces your investment, right? But this will happen only when you have what? Replacement situation. Now tell me, what are the questions you have to ask your client to get a cash outflow? What is the cost of machine? Number 2, are you investing any installation cost? Number 3, is it essential to make investment working capital, sir? That may not. Hello? Then you add all these things. Then, is there any subsidy you are getting? Deducted. Do you have any old asset to you are selling in order to make investment on this asset? If client says no, in such a case, ignore. When client says I am not getting subsidy, ignore. Okay, this is the procedure. These are the format CA Institute has given me. Certainly they will develop a problem by considering working capital, by considering subsidy, by considering installation charges, by considering net sale proceeds from old asset. Note it down. See, already I told you, entire chapter is based on only 2 things: inflows, outflows. That's why you must get the excellency in inflows estimation, outflows. There the matter chapter ends, right? Whatever the problem you take, 23 problem, 24 problem, basic idea is this. That's why each and every concept of inflows and outflows, you have the such a clarity. Okay, ma? Now tell me, cost of machine, cash outflow, tell me. Close your eyes, tell me. Cost of machine, sir, plus installation, sir, plus working capital, sir. Sir, Balu, sir, 1 minute. Working capital is need not, sir, for all the project. Hello. For petrol bunk, you need. Chandana brothers, need, man. For Chandana brothers inventory, what is that? Saris. Okay, Swagruha sweets. Sweets. Building is fixed asset. Sweets, Apollo Hospital, Apollo Pharma, medicine. Purchase of land, fixed asset. No, just buying land also, investment only. But thing is, it don't need of what? Working capital. So that is the point. Next, cash outflow is gone. Next, what is that? Inflows. Here the problem is happens. 20 problems in your material means all the problem directly, indirectly links with this inflows and outflows only directly. Next, inflows means there are 2 types of inflows. Regular, ending. Regular means what you are doing regularly. At the end, what do you do? Terminal. So that's why regular cash inflow is also called, what is that? Operating cash inflow. Here it is. How do you calculate operating cash inflow? Here operating cash inflow includes, this is operating cash inflow includes this much. Operating cash flow, how do you calculate? First, ask the client sales revenue. He may say that credit sales, get lost from here. Don't. Credit sales means I am not going to find it out what exactly inflow, right? My job is to exactly inflow how much. That is the reason you have to take what sales? Only cash sales. Credit sales, ignore it. A client made 100 crores, but only 5 lakhs is the cash sales. In such a case, how much you have to take? Only 5 lakhs only. Sir, credit? No. Sales. From the sales, what do you have to deduct? Variable cost. What is another name of variable cost? Variable cost. Another name is variable cost. Acha bacha hai. Variable cost also called what cost? Direct cost. What is that? Direct cost. Okay. Less variable cost. Then you will get what? Contribution. Less what cost? If at all fixed cost is there, you can deduct a fixed cost. Then you will get it, what is it? Profit before depreciation and tax. Then less deduct, what is it? Depreciation. Balu sir? Now the question arises here. Balu sir, just now you told that you are going to take, what is it? Only cash inflow. Hello sir, depreciation is a non-cash expense, sir. Then why do you take? Yes. I don't take, my intention is to not to take what? Depreciation. Because depreciation is a non-cash expenses. But I will take only to skip what? Tax. When tax is there, depreciation is there. That's why one of the rule, Balu sir rule, when T is there, D is there. When T is not there, D is not there. What is a T? When T is there, what is there? Depreciation is there. When no T, no D. In order to make you to cheat, they will give you depreciation. They will write a depreciation. But they won't give a tax in the problem. In such a case, no need to consider what is that? Depreciation. But sometimes they will give you tax. Problem is silent with respect to depreciation. No, you have to consider depreciation. Sir, method not mentioned, sir. Take assumption. Sir, which method I will take, sir? Take your own assumption. But the thing is, when tax is there, depreciation is there. Whether he mentioned in the problem, not mentioned in the problem. But when depreciation is mentioned, tax is not mentioned. In such a case, no need. For every three lines, he will add a depreciation word. Company asset gets depreciation this much. But tax is not there means no need to consider. Okay, Maji? That is depreciation. Then you will get the PBT, less tax. You will get, what is it? PAT. This PAT also called what profit? Accounting profit. What profit? Accounting profit. And again, once profit tax treatment is finished, what do you have to do? Add back. What do you have to add back? Depreciation should be add back to whom? Add back to, not to what? Accounting profit. That is a PAT. Then you will get it what profit? Cash profit. This is also called CFAT. Okay. Now tell me, what is operating cash flow? Don't see that one. Close your eyes. Tell me. Sales revenue. Sales means what sales, sir? Only cash sales. Sir, credit sales 50-50. No. Total sales are credit. No sales that year. Sir, sale chesam, sir. Mottam credit sale chesav. Ye labam po. Get lost. So that's why take sales revenue minus variable cost. You will get a contribution less fixed cost. Next, a profit before depreciation and tax. Sir, depreciation non-cash, no sir. Then why you taken, sir? There is a rule. T is there, D is there. So in CA Institute, two problems given. In one method, tax is mentioned, but he could not mention what is that? Depreciation. Saying that student also ignore what? Depreciation. Should we ignore? No. In another method, depreciation he mentioned, but a tax he ignored. In such a case, you also ignore what is that? Depreciation. This is the logic to be. Two problems only basing on this point. Then accounting profit you will get it, and add back to depreciation you will get the CFAT. You note it there. Tomorrow We will calculate terminal cash inflow. Then we will take another most important method, that is called, what is it? Payback period. Right, ma? Well, so yesterday we discussed what is the capital budgeting, right, ma? Investment decision. So idea, capital budgeting is, it is a process and evaluation and selection of what? Long-term project. If you learn, it will guide you how to invest on what asset? Fixed asset. How much to invest, whether it is worthful to not. Examples for capital budgeting is purchase of land, machinery, factory building, all these things, right? What is the purpose behind learning this one? Tell me. Purpose, or you can say significance. Tell me significance. Yeah, substantial expenditure, long period, irreversibility, and complex decision. So capital budgeting basically consists of what? Various methods. Each method has its own calculation. After calculation, you will find the end figure. Basing on end figure, you have to take what? Decision. So in the calculation process, sometimes you have to take what? Assumption. Sometimes you have to take conditions. Condition, what's that? Number one, sales happens during the year. Yes or no? But we will assume that end of the year. It is one of the condition. Okay. Assumption means sometimes tax is given, depreciation is not given. In such a case, you may take it a depreciation either a straight line method or WDV method. Okay, this is an assumption. In a year, either you may take 52 weeks, 365 days. Are you getting? These are the certain assumptions. Sometimes crores of rupees are given. In such a case, amount is considered in crores. You can take it in decimals in order to fast calculation. And capital budgeting methods being classified into two types. What are they? Traditional methods, modern method. Traditional methods ignores time value of money. Modern method considers time value of money. What are the traditional methods? Payback period, accounting rate of return, net present value, internal rate of return, profitability index, and discounted payback period. Okay. Thereafter, what we analyzed it. Every project have, in order to evaluate each and every project, you have to consider the followings. What are they? You have to consider which one? Cash outflow, cash inflow, life, and tax. How to calculate cash outflow, cash flows when it happens, cash inflow when it happens, you must know. Every year beginning and every year ending. Every year ending, what cash inflow happens? Operating. At the end of the terminal, beginning, cash outflow. A project is financially feasible when? When cash inflow of the project is greater than cash outflow, then project is worthable. This is the basic idea. In order to calculate this one, you have to understand how to compute what is it? Cash inflow, cash outflow. Why I had shown this one yesterday? In order to make you to understand treatment of what is it? Working capital. So here, how to calculate the cash outflow of the project? Cost of asset plus installation charges plus what are they, ma? Working capital subsidy from the government. So all these things, cost of machine, installation charges, working capital, subsidy, net sale from old asset might be considered. What is the next one? Here the treatment of working capital, what should we do? Means that I will explain last. Right. Here you have to calculate another cash inflow. What this cash inflow? Operating cash inflow. Operating cash inflow. Every year company operates. Every year company operates means what? For example, in Mastermind, you are a student. What is your operations in Pradipet? Get ready, have a breakfast, coming here, learning FM. Yes or no? Only FM, right? Okay. So the point is, your regular work, what you supposed to do is called business operations. A business always produces commodity, makes a sale, and generates a profit. From the revenue, after deducting cost of whatever the inflow it generates, that is called what inflow? Operating cash inflow. To calculate operating cash inflow, you have to consider all these things. Sales revenue, less variable cost, contribution, less fixed cost, profit before depreciation and tax, and less depreciation, PBT, tax, PAT, add depreciation, and you will get it. What is it? CFAT. Okay. Here sales, what sales we have to accept? Only cash sale. Sir, actually, why you are taken, sir? Depreciation. Depreciation is a non-cash expense, sir. When there is a T, there is a D. When there is no T, there is no D, right? Thereafter, one more cash inflow left. Which one? Operating cash inflow we concluded. Now we have one more cash inflow, that is called terminal cash inflow. Where it is? This is the terminal cash inflow. The word terminal means what? There is a movie called Terminator. Arnold Schwarzenegger movie. Have you heard the word movie? Terminator. Terminator means the person who destroys everything. You know, old Telugu movies, Terminators are police people. They will come at last. Yes or no? Termination, last ending of the period is called what is a terminal cash inflow. Yesterday I told you the two meanings: salvage value, scrap value. Salvage value, scrap value difference is very simple. When asset is not in a position to use, then you will scrap. But asset is worthable, you may not use, but somebody can use. In such a case, if you sell the asset, then it is called what is that? Salvage value. You try to understand at the end of the period what happens. By chance you purchased asset. You used asset over the period of how many years? 10 years. At the end of the period, you are going to scrap. Either salvage value, scrap value, treatment will remain same. Hello. Treatment remains same. You sold the asset. By chance, whatever the asset you purchased given year before, if you are scrapping at the end of the period, whatever the return, whatever the revenue you will get, it is called what is it? Gross sales revenue. What is that? Gross sale revenue. Once you sell the asset in the market, if you generate any revenue, income tax people will approach you saying that pay tax. In such a case, what we have to do? We have to calculate written down value. What value? Written down value. Written down value means cost minus accumulated depreciation. At what price you purchased and how many years you used. Every year depreciation is how much. In accumulation, what is the total depreciation? From the cost, if you deduct what is it? Depreciation, you will get the written down value. By comparing this with both, which one? Gross sales revenue with written down value, you may recognize or you may explore capital gain or capital loss. For example, your written down value of the asset is 2 lakhs, but you sold for 10 lakhs. You try to understand. Worth is how much? 2. You sold for, in such a case, the difference is capital gain. In capital gain, you have to pay tax. Suppose the written down value of the asset is 2 lakhs, but you sold for 50,000. In such a case, loss. So if it is a situation, take him to tea stall. Whom? Income tax department. Take him to tea stall, sit that side, make him to sit that side, you sit here and make a discussion. If gain is bhaiya, mai dunga tereko. What? If gain is there, I will pay bill. If loss is there, you pay the bill. It means that what? If at all loss is there, you have to give me. If at all gain is there, I will pay. Okay? This is the maximum deal. In such a case, when loss or gain, you can recognize only when you start to compare which one? Gross sales revenue with what value? Written down value. Got it, ma? So if gain is there, pay tax. If loss is there, get a tax shield. So that is the point. Sir, what is the difference between gain and profit, sir? See, profit is regularly happens. Gain happens only once in the life of the asset. Gain seems to be post-mortem. Profit seems to be operation. How many times we can take an operation? Your choice, n number of years you can take any type of operations. But post-mortem hota hai? Only one. That is a gain or capital loss happens only once. Now here the tax and tax shield, you got it. And now if it is gain is there, you have to pay tax. From the sales revenue, pay tax. If it is loss is there, you got the loss and collect the tax shield from them and tell to the client that you sold this much of asset and you got this gain. So both would reflect what is it? Net sale proceeds from the asset. You see, net sale proceeds from the asset is A minus tax. Hello? A minus tax or A plus tax shield. This is with respect to fixed asset. And there is a treatment, recovery of working capital. What is this working capital, sir? Means previously I told you, let us take, when you are going to start any business, you need to make an investment on given assets. Already I discussed with you, right? Here, you try to understand. This is the project I want to say. This building is what? Fixed asset. Petrol, current asset. I started business today itself, right? I invited all you students, right? So if the people came, 70 lakhs I invested on fixed asset, 30 lakhs invested on petrol. Total my investment is 1 crore. Now all the students came and they purchased petrol, means once petrol is get finished, right? Should I, in order to buy petrol again, should I invest additional amount? Why? Already invested amount you sold, sir. So that 30 lakhs is there. With the 30 lakhs, again you can buy. For example, if you might have sold the petrol more than the purchased price, you have more amount in your hand, right? If you sold less than the given price, you have less, but certainly it would be. Okay, then immediately I will start to buy the current assets. That is called working capital. Means petrol. Here you try to understand. Petrol is nothing but, current assets is nothing but working capital. So this working capital, what happens? Gets circulated. But fixed asset gets depreciation. Keep it in mind. As time passes, fixed asset depreciate, disappears. What is that? Fixed asset depreciate, may disappear. What about working capital? Working capital never disappears. Working capital circulates. But remain same. Remain same. Now tell me, fixed asset depreciate, may disappear, but current asset circulates but remain same. At the end of the terminal pay, at the calculation of terminal cash inflow, whatever the cash inflow whatever the investment you made it on, what asset? Current asset. That amount would remain same, logic you are getting. So working capital will remain same. Either problem gives direction, specifically that only 50% amount on working capital you have to take while calculating terminal cash inflow, means we have to follow the direction. If nothing is mentioned, how much investment you made it, the same amount to be recovered. For this purpose, you have to understand this one. Now tell me, here it is. What is the working capital? It is important to note that project may also require, what is it? Additional working capital during the life of the investment. Working capital of current assets needed for smooth running of business. Why company need working capital? For smooth running of business or in order to generate return. What is its treatment? Add to initial investment and recover it from terminal cash inflow. How much percentage? 100%. 100%. So here it is the basic rule, what I told you. One of the rule you should keep it in mind. It's my rule. Okay? If you follow it, then you can understand comfortably. But that Balu is this boy. It's not me. What is it? Rules are rules. తాట తీస్తానన్నాడు. ఇవి నేర్చుకోవాల్సిందే. What is the rule means? Fix it. What is the rule? Fixed asset depreciates and disappear. Current assets circulates but remain same. This is the basic identity. See, we have to make our subject so interesting. If you learn it in a dry mode, right, we will get vexed. That is the point I am giving all these things, right, ma? So working capital, how much you will make investment, there is a chance to recover it, right? And terminal cash inflow here, add recovery of working capital, basing on assumption. If nothing is mentioned, how much? 100%. So terminal cash inflow, you got it. F plus E means what? Net sale proceeds and recovery of working capital. So this is the treatment, dear students. Got it, ma? Right. Make it note this.
Recording stopped.
Here, right? Grass. Right. So with this, operating cash inflow, terminal cash inflow. What is the how to calculate once again? Operating cash inflow. This is cash outflow, tell me. 90% our chapter is finished. 90% chapter finished. Once you are perfect with respect to only these three. Cost of cash outflow. Cost of machine. Installation charges. Working capital. Subsidy. Net sales proceeds from. Yeah. Thereafter operating cash inflow. What is the working capital treatment? Working capital treatment. Just so you understand, no need to write this one, right? Working capital, add to initial investment and recover it. Basic rule, fixed assets, depreciate may disappear, but current assets will circulate, remain same. That's why you have to recover how much? 100%. Terminal cash inflow, remember, right? Gross revenue, gross sales revenue, written down value, capital gain, tax or tax shield, net sale proceeds, and add recovery of working capital. Okay. With this, the basic ideology of this chapter came to an end. Now, let's move to the problematic zone. What is the first problem given in your list? This is the problem list, Namma. You got this document? General introduction, capital budgeting. Capital investment decision. Problem number 1. First problem is there. So, where is our material? Take that material. See, each and every problem beside, after completion, you write the percentage of understanding. How much? Whether you understood 100% means put in 100%. If not means write there itself. Even though I explained effectively, But if it won't reach it, put it their word or 50% or 60%. And after that, you read the problem. If you are unable, then bring to my notice once again. No need to, after completion of the chapter, to make evaluation. Each and every problem, is it beyond my capacity or not? In such a case, suppose I teach 20 problems or 15 problems. Out of 15 problems, 13 problems you are effectively do. So only you are weak at 2 problems. That 2 problems we will work together still to the date of public exam. Are you getting? Instead of again, whatever the problems you can handle or you can capable to solve, why again you are spending your valuable time on it, right? So where, in which area you are weak or very low, there you have to put all your energy to coming up from that, right? So that's my strategy. Keep it in word. Yes. Now we take problem number, what is this? Problem number 1. One is accounting rate of return. I will discuss with you later. Last I will give this problem is a priority. Then 2 is not there. Then what is the problem? I will give you. First take the model called payback period. What is that? Payback period. You take this one. Which problem? Payback period. Go to that order. You follow that order. It would be very, very easy for you. How many ma? Problem number 16. 16th problem is there, you know? Yeah, first method you take it is put it heading this model payback period. What is it? Payback period. Maximum one of the time frame the examiner gave this problem for 10 marks. We should not ignore this importance, right? Payback period. This is the payback period. You consist this title itself consists of 3 words. What are they? Pay means invested. This is inherent meaning. Back means recovery in the form of what is it? Cash inflow na outflow na? Cash inflow. It is nothing but time. Period means what is that? Time period. So how they have given the title for this? Pay invested is going to back from its cash inflow. That is nothing but time period. This is how much? This is called payback period. What is it? Payback period. Now try to understand. Here is the investor. He made it investment in this project. So now tell me, cash outflow comes or goes? Goes. That is nothing but pay. He paid it. So cash outflow goes. Now with that cash outflow, this business, this organization performs a business, right? From that business, it generates what is it? Cash inflows. Maybe that operating cash inflow or terminal cash inflow. We will get it back, right? Right? So the situation is, how long we invested and we getting a cash inflow, but how long we have to wait? Is it a day, months, week? This is called, what is it? Payback period. Very simple. So payback period. Now try to tell me what is the meaning of payback period. Payback period. It is a time period or length of time duration in which invested cash outflow can be recovered from its cash inflow. So why you study, sir? If I invest my project, how early I may recover my investment? That project looks very beautiful to me. Hello? If I invest 100 crores, One project gives my investment back 1 year, another project gives after 10 years, but it will give more profit. Now tell me, in this method, it never consider that how much profit you are going to make. That is irrelevant. But how fast you are going to recover your investment. That's enough. From the 10 years life, you recovered your investment is within a 1 year. Remaining 9 years is profitability only. So this the ideology of this method is little bit innocent method, because you are an investor, you make investment. For what purpose you will make investment? At least to make some money, yes or no? But this method speaks that don't consider how much profit you are going to make or how much income you are going to make. Consider only recovery, how fast you can recover your investment. That's enough. Only that is the point. So payback period, it is the time period required to recover your investment. The project which has the least time period, that would be the best. See, payback period is length of time required to the cumulative of total cash flows from the investment equal to initial cash outflow. Simply, I will give you a word, note it down. Payback period, it is the you see here, payback period, it is the amount of time required for firm to recover its initial investment in a project as calculated from its cash inflows. Payback period also termed as what? Payout period or cutoff period. Right. This, how do you calculate the payback period? Ela estimate as a corporate companies, how they will estimate. First you calculate what is it? Cash outflow. First estimate cash outflow. That is the reason I told you. Do you know how to estimate cash outflow? Okay? Cash outflow. Then you have to calculate cash inflow. How many cash inflows? Operating cash inflow and terminal cash inflow. Then you have to follow the formula. But to use this formula, you have to identify that when cash inflow might be, what is it? Every year equal. Hello? Here every year the cash inflow might be equal. Equal cash inflow is there. In such a case, the calculation would be like this. Every year cash inflows are, what is it? Uniform. Uniform means every year same. For example, I will tell you an example. See, you made it investment of 10,000. Every year you are getting 5,000, 5,000, 5,000. Then what is the formula? How long you have to wait to recover your investment? Array, you invested 10,000 in a business. Every year it is giving 5,000, 5,000, 5,000, 5,000. It means that the cash inflow, uniform, equal, yes or no? Equal means how many years? Tell me in formula. Cash outflow into 2. Cash outflow 10 into 2. Very good. Cash outflow divided by annual cash inflow, right? So that is the formula, right? What is the formula? When cash inflows are equal, in such a case? Yeah, here you see, when the net cash flows are uniform over the useful life of the project, then payback period would be total initial investment divided by annual cash inflow. Yes or no? This is the procedure. When that is the reason you see, you can calculate like this. Now tell me payback period. What is the formula? Initial investment divided by annual cash inflow. Where is how do you calculate? 10,000 divided by 5,000, right? Then you will get it 2 years. So this is the payback period. When cash inflows are equal, this is a uniform. When here not uniform means it is not equal in every year. In such a case, what to do? You see, in such a case, now you tell me, you invested how much? 10,000. First year you got it 2,000. Second year you got it 3,000. Third year you got it 1,000. Fourth year you got it 3 and 8. Every year cash inflow equal or unequal? Unequal. In such a case, average, no. Now tell me how long you have to wait. Here I will tell you one simple rule. Recovery balance. What is that? Recovery balance. For example, you invested 10,000, right? First year, how much you recovered? 2,000. What is the balance? Again, you have to wait, right? Next year, again, you would work the business. Second year also, you worked on you extracted a lot of your sweat. Second year, you generated 3,000. What is your recovery at the end of second year? 5. What is balance? Again, third year also you have to work, right? Third year again you waited. 1,000 you got it. What is the recovery? 6. What is the balance? Fourth year. Also you done a business. How much you got it? 3,000. What is the total recovery? What is the balance? It means that one thing is confirmed. In order to recover your investment, you have to wait up to fourth year. Fifth year, if you say, fifth year giving, what is it? 18,000. It means that it is, if you consider fifth year, your investment is exceeding your recovery amount is exceeds your actual investment. Hello? So in such a case, shall I tell you, shall I ask you, should you wait for 4 years or 5 years? 5 years, fourth year plus. Yes or no? Fourth year plus, but not 5 years. Simply keep it in word. Fifth year is different from 5 years. Fifth year is different from 5 years. Now you are saying 5 years. Not a 5 years. It is what? Fifth year. Fifth year means you should not take 5 years. Fourth year plus. Are you getting? Now for that purpose, shortcut rule. R means what? Recovery. And you have to keep balance. RB. If you identify, you know that how long you have to wait. Now tell me in this problem, how long you have to wait? 4 years you have to wait. 4 years plus maybe weeks, days or years of the concerned fifth year. Are you getting? In such a case, I have to wait for how many years? Exactly, in a year. 4 years. But I am going to collect fifth year, but I should not say 5 years. Okay? If you go to the fifth year, you go to the fifth year now. Fifth year, if you do that fifth year, if you do 1 year, you will generate how much? 8,000. But actually, how much you have to recover? 1,000. For the sake of 1,000 in fifth year, no need to spend entire year. For 1 year or 12 months, if you wait for 12 months, that business will gives you 8,000. For how much you have to recover? 1,000. For 1,000, how much you have to wait? Just you add back to that one. So that means In order to know this one, you have to understand what is your recovery amount, what is a balance. First point, number one. Number two, fifth year is different from 5 years. Our fourth year is different from 4 years. So here the formula is, how do you calculate means every year, covered year, how long you have to wait for investment recovery, then you have to take what is that? Balance divided by next year cash inflow. Okay, so this is the basic formula. Just now you told that same. So you have to wait for how many years? 4 years. 4 years you took. The 4 years is nothing but 4. What is the balance to be recovered? 1000. For that purpose you have to wait for which year? 5th year. So then you can take it 1 divided by 8. Okay, you will get it 4.8 years. If you want to convey this data in months, right? In months, if you want to convey 4 year months, multiply to 12. If you want to convey in days, 365. If you want to convey in weeks, 52 weeks. If you want to convey in year, into 1. This is what, man? That boy. This answer, final answer, 4.12 might be. Okay. So this is the formula to be considered. Now tell me, what is a payback period? Balu sir, payback period means it is a time period in which invested cash outflow can be recovered from its. Right. Number 2. Step 1 line gap. Note it down. Steps 2. If you want to get advantage of my class, right, you must be expert in writing. Otherwise, you will stare it. IP. But once this notes is with you means, try to understand. You can handle. For how many years you have been studying? For how many years you have been studying? Take from baby class, LKG to. 17, huh? 7, not, I'm not asking age. Okay, education, okay. Time, okay. How much money you might have spent on education? Not food, you deduct the food. Only education fees, books, hostel, means that is also relevant for this one, right? Maximum. This is the situation. When you are going to end your education, when you are going to start to make money, how long you have to recover, to recover your invested amount. If you calculate, you will get vexed. But your CA students, there is a lot of chance for you. If one person aa gaya bacha with 10 fingers, 11 rings, with the bench car, little bit of financial pressure, then automatically we can recover one day. One transaction is enough. So that's why Payback period also says that if you are able to recover, for example, you see the political people, they will make investment, right? Crores of rupees investment they will make. But if they win seat, if they get any ministry, one day is enough for them. One day is enough for them. They can recover. So that is a payback period. Alright, first this one finished. Step number 1, what to do? Cash outflow you calculate, cash inflow, then apply the formula. Formula number 1, how do you calculate? First one, estimation of payback period. When the net cash inflows are uniform over the useful life of the project. In such a case, payback period would be, simply you can write this formula. Payback period would be payback period equal to initial investment divided by annual cash inflows. This is the first formula. When cash inflows are not uniform over the useful life, then covered year balance divided by next year CFAT. For this purpose, you can also convey in, what is it? If it is a year, multiply with 1 year. Months means 12. Weeks means 52 weeks. Days means either 365 or 360. Any of the thing you can take into the consideration. So this was the very, very important point, ma. Here also you can calculate payback period. Here also you can calculate payback period. What is date today? 30. Tell me exactly date. Your batch is, this is 1115 31st May, right? 31/05/2023. So what problem we have to solve now? Problem number. Okay, one more thing is, once completed this one, you have to understand decision making. Okay, how do you calculate the decision? See, dear students, once payback period is calculated, hello? Once payback period calculated, the decision would be taken like this. whether you have to ask your client whether the project is single or multiple project. Single project, only one project. In such a case, what we do? Calculate payback period. Payback period is less than standard payback period. The question arises, what is the standard payback period? So the client who is interested to recover his investment, that is called, what is it? Standard payback period. When he comes with our to our office, he need to know payback period and he know what is standard payback period. Are you getting? He need to know payback period, but he will come with standard payback. We will come with that, okay, my investment, if at all I am able to recover within 4 years, this would be good. But he will give you all the data. If you calculate payback period, if you say the payback period is your project is 2 years, actually he came to recover 4. But after calculation, it is clear that he is going to recover his investment within 2 years. Then project is acceptable, right? So that is the point you have to keep. When payback period is less than standard payback period, project should be acceptable. Payback period is more than standard payback period, reject. Payback period is equal to standard payback period, either accept or reject. Okay. When client don't carry any standard payback period, means you cannot say any decision. In order to, you want to explain whether the project is really worthwhile or not, means the client must have certain payback period. That is called standard payback period. Second one, multiple projects. What is that? Multiple means more projects. When client comes with a multiple project, being a CS student, you have to ask what is the relationship of that project. Either it is mutually independent or mutually exclusive. Mutually independent means each and every project don't have relationship with one another. So each and every project gives unique services to client. In such a case, you need all the project. What do you do in such a case? Accept all the project if the payback period is less than standard payback period, because you need all the projects. Mutually exclusive means one investment decision of the project will influence another investment. Then mutually independent means independent. All are unique. In such a case, take all. Mutually exclusive, yes or no? In exclusive, you keep the word excellent. Excellent never be 10 or 16. Excellent would be only one. Are you getting? Mutually exclusive annadanko. So you have to identify one project we need it. That is called excellent one. Mutually independent means, let us take India. India treat all the people same. Hello? Mutually independent. India. Okay, India. What happens? We will treat what? All are same. Mutually exclusive. Okay, exclusive means excellent. Excellent always one. This is the shortcuts. To remember, that's enough. You should not apply. I am giving to make you pass. Are you getting? So in mutually exclusive, will you take all project? Only one. That project payback period should be higher, lower? Least. How least means then it is possible. Okay, this is the decision making. This information is there in your material. No need of this. Now tell me once again, fast recovery. What is the payback period? Amount invested. It is the time period in which invested cash outflow can be recovered from its cash inflow. How many steps required to calculate? Step number 1. Step number 2. Step number 3. Right. How do you calculate payback period? Balu sir, that depends upon your input. Input is your cash inflow. Cash inflow equal, unequal. Equal, then initial investment divided by annual cash inflow. Unequal. Covered year plus balance divided by next year's CFAD. How do you take decision? Sir, decision, tell me either single or multiple. Single. Do you have any standard payback period or not? Yes or no? Yeah, standard payback period I have. In such a case, payback period is less than standard payback period, accept. Payback period is more than standard payback period, reject. Payback period equal to standard payback period, either accept or reject. Mutually independent means independent. India means all project is needed. In such a case, accept all if payback period is less than standard payback period. Mutually exclusive. Exclusive ante excellent means one basic payback period which project has, that should be accepted.